All right, we're going to go ahead and get started. Good morning, everyone. My name is Micah Matthews. I'm one of the marketing directors here at Messer Financial Group. Just like to start off by thanking everyone for taking time out of their busy schedules to join us this morning for our part 3 of our 3-part series on the Victory Series plan with Manhattan Life. If you've attended the other 2, I'm sure you've already started thinking of prospects that this product can fit with. And you see the value that it offers to your clients. Anybody that's working in the under 65 health market needs to have this product in their portfolio. We are going to have questions at the very end. You should see a place on your webinar where you can ask questions. We will hold all questions till the very end when we go over that. So feel free to type in whenever you're ready. Again, this is a perfect substitute for an ACA and even addition for the ACA. So you're definitely going to want to have this in your portfolio. We are joined with Mike Binke. He is the creator of this plan. So we are bringing you the best in the industry to go over this. And I think once this webinar is over, if you haven't already, you will see exactly how this will fit in your client's repertoire. So again, we have a lot of great information to go over with. It should take about an hour. We'll hold all questions to the end. And with that, Mike, I'm going to turn this over to you. So go ahead, buddy. Take care.
Thanks, Micah. Good morning, and thanks, everyone, for tuning in. For those of you who may not have participated in the first 2 for one reason or another, we started out by looking at a pretty significant claim that got pretty close to home to answer the question, are limited benefit plans worth their time? And I think we concluded that certainly there was a need in our market for this type of program. So then we expanded out and said, okay, let's look at everybody. If these type of products make sense, let's look at everybody's and see whose makes the most sense. And I think we found Manhattan's Victory Series to be at the very, very top of claims paid in a variety of claims and at the bottom of the premium necessary to have the coverage. And with commissions in line and underwriting perfect, there's really no reason not to consider us at the top of the heap. The second presentation was more nuts and bolts, mechanical, dot the I's, cross the T's. How does this benefit work? What does this benefit work? And I think that while that can be a little bit tedious, it's important, but we went through that. So now we've got a third webinar coming. We've pretty much covered the typical material. And I wanted to do something that would be of value to you. I talked to administration, said, what kind of feedback are we getting from the field? Christy Bird, many of you know Christy, has been here for, gosh, well, there's trees out front that are younger than Christy and I. She said that the predominant question has been something along the lines of, okay, who do I sell it to? Who do I need to be looking for? Who would benefit from this product? Some variation of the who should I be looking for theme. So, okay, well, if that's the question, let's go through here and see if we can determine some answers. Here's a team picture of you guys over the past couple of weeks. So let's see if there's anybody out there, if there is a type of person or a category of individual who appears that they might benefit from a Victory Series plan. We'll look at a variety of them. Maybe it'll work. Maybe it makes sense. You be the judge. But if it does make sense, then you'll have a better idea about target prospecting, target marketing. I want to introduce you to Billy Bucks. We all have clients like Billy. Billy is a high-income earner. He wants and can afford the very best, and that includes ACA health plans. Now, what are they going to cost in 2019? Many of you have not even looked, but you can go to healthcare.gov and get a feel for where the premiums are for 2019. When you do that, they will show you the average of the top 5 per category per state. Before we get into that, I want to remind you of something. The premiums may differ between bronze and silver plans, and gold and platinum for that matter. The deductibles may be a little different. The copays can change. The drug formularies aren't exactly the same. but the exposure, the maximum out-of-pocket by law is the same. So if you sell someone a silver plan instead of a bronze plan, understand that it might be more suitable. It might be worth the difference in premium, but in a worst case scenario, they're not going to be better out of pocket. Just understand that going in. And if you don't, talk to your manager or talk to somebody that does understand it and let them explain it to you, because it's a key integral element in everything that we do in financial planning. The mandated maximum out of pocket is going to be the same. Now, here's what you find. We picked 3 states, South Carolina, North Carolina, and Georgia, specifically Charleston, South Carolina, Charlotte, North Carolina, and Atlanta, Georgia. We took 3 ages that were right in the middle of our age bands. We chose 29, 48, and 63, and we're going to stick with those consistently throughout the presentation so as to compare apples to apples. For example, at age 29, if you look at the average of the top 5 bronze plans, by the way, what's the max out of pocket on a bronze plan in 2019? Answer, $7,900. All of these numbers are based upon $7,900 of maximum out of pocket. We see the bronze plan is going to cost a 29-year-old, and we're using non-smoker rates here too, folks, $328 a month on the average. Now, can you find one that's a little less expensive than that? Sure. By definition, you have to be able to, because that's an average. Silver plan, the average, $460. Now, the little number over here in brackets, in parentheses, you'll see it throughout the presentation, represents the difference in premium between these two. So you don't have to be fumbling with your calculator. A person wants a silver plan because they like the drug formulary better, or their particular need for specialists might make more sense. Does it make $132 a month more sense? That's the question. At age 48, when the average in South Carolina and Charleston area bronze plan cost a 48-year-old $480 a month, is it worth paying almost $200 a month more for a silver? Maybe it is, maybe it isn't. That's why they need a trained, knowledgeable professional to help them make that determination. And that, sports fans, is you. The reason we get together and go through training like this is to do nothing more than enhance your knowledge and experience so you can do a better job of advising them on their needs. At age 63, the average cost of a bronze plan in Charleston, $866 a month. Silver is $1,213. That's a difference of $347. North Carolina, you find the rates fairly similar, and the same in Georgia. But we broke it out just so that you could see that no one state was an outlier. The bridge plan, which we've reviewed up till now, which is sufficient to reduce or eliminate the cost associated with an average hospital stay with surgery. Here's the difference in premium between a bronze and a silver. Here's the cost. So a fraction of the difference can be used to take them off that $7,900 exposure and put them into what is likely to be done. Now, I believe this presentation, unless we lay an egg, is going to be available online. So if you want to come back and check these numbers at some point in the future, you can do that at Mestra's website. You don't have to go into healthcare.gov and reduplicate all this effort, because this took more than a minute. But feel free to do so if you want. Let's look at a couple. Now we're going to take 2 29-year-olds, 2 48-year-olds, and 2 63-year-olds and do the same thing. What is the average premium going to be in Charleston, Charlotte, and Atlanta? And there it is. Looks like I forgot to put the math in here. About $250. $959 for a 48-year-old couple, almost $1,000 a month for a bronze plan. Over $1,300 for a silver plan. $350 or so. 86.30. So for a fraction of the difference in the premium between a bronze and a silver plan, they can mitigate all of the exposure for an average hospital confinement. And of course, once again, they are the same rates in all three states. Let's look at the family. The cheese gets binding when you look at the family. Two 29-year-olds. I think we added an 8-year-old. We're not even talking about a big family. $881 a month. Or for $353 a month more, you can get a silver plan. Maybe the specialty copay is going to be a little bit better. Maybe you'll have a better drug copay. But $353? The family would have to be pretty health challenged, I think, for that to be worthwhile. And at age 48, it's $474. And look at here. The average of the top five, almost $2,000 a month, and $27.39. So for $783 a month, can they do anything to mitigate that exposure? How about $128 at age 63? $91.99 at age 29. And once again, the rates stay the same in all three states. So there are some things that you can do to help a little bit. So if you've got Billy Bucks out there who can buy anything that he wants, and he's trying to determine what does he want, clearly he wants an ACA plan. He's not getting any help with the subsidy. He's going to have to pay for it. So what's the best thing for him to pay for? I propose to you, it makes a whole lot of sense to buy a bronze plan, reduce or eliminate the out-of-pocket exposure associated with it for a fraction of the difference between a bronze and a silver plan, and use the rest of the money to sell him the life insurance that he hasn't purchased that he keeps getting around to. Once again, what's the bridge plan do? When you add it to any ACA qualified plan, because the law stipulates what the max exposure can be, and it works with every one of them. Gives your client the reasonable expectation, the likelihood that they'll be able to leave the hospital after an average period of hospital confinement and owe very little or nothing in the way of out-of-pocket costs. Remember the two costs of health care? What do I pay to have insurance? What do I pay when I use the insurance? If you can't afford both, you can't afford your program. Now let's look at a cholecystectomy. For those of us who don't have a medical degree, that's a gallbladder removal. What's the our supplemental design, our bridge plan, going to pay? For the benefit, $50 times 5 days is $250. First hospital confinement benefit for 4 days is $4,000. Surgery, $5,000. Anesthesia, $1,000. That's $10,250. Now here's a question. How many ACA qualified plans have a maximum out-of-pocket limit above $10,000? And for those of you who've been into business for more than 20 minutes, you know the answer is none. All out-of-pocket limits are required to be well below that amount. So if your client had any ACA qualified plan and our bridge plan, and he went in the hospital for 5 days to have his gallbladder out, what would his exposure be? And the answer is nothing. Now think about this. Somebody sold Billy that plan that he purchased. If his agent had said, Mr. Bucks, your premium cost at age 29 is $328 a month with a $7,900 out of pocket for an average hospital stay. Or for $362.50, we can show you a plan where the likelihood is for the same experience, zero out of pocket. Which option do you think Billy would have taken? owe almost $8,000 for $328 a month, or owe nothing for $362.50. He's pretty financially savvy. I propose to you that Mr. Bucks might pay just a little bit more to save a bunch. At age 48, it's a similar consideration. Same exposure, $480 premium. We looked at it on average. $525, zero out of pocket. How about age 63? Does he want to pay $826 to be $8,000 out of pocket, or is $878 zero? I think we see three examples here where an astute individual would recognize the value in paying a little bit more. Well, what is this plan? What is this mysterious plan for zero out of pocket? It's nothing more than the same identical ACA plan plus the Victory Bridge. Meet Sallie Subsidy. I'll bet you guys do a lot of work and spend a lot of time with the Sallies of the world. Most of the time, for most of you. Hardworking, honest, industrious person. Really like Sallie, but she doesn't make a lot of money. She likes value because she has to. The more limited your budget, the better attention you have to pay. So what's Sallie going to do? Years ago, in the past, Sallie couldn't dream of affording major medical. But now, since she gets a significant premium subsidy through the ACA, she can get the best coverage out there. One problem left to overcome. What happens when Sallie or her husband or one of the kids needs to go to the hospital? Like most coins, it has two sides. She doesn't make much money, so she gets a real break on her premium, which is wonderful. It means she doesn't have much disposable income. So where is she going to come up with thousands of dollars when one of them needs to use the plan? Remember the two costs? What do I have to pay to have insurance? What do I have to pay when I use the insurance? Well, Sallie's got have covered. Sallie has most of her premium paid, but she's still responsible for her out-of-pocket exposure. This little chart shows hospital utilization in America. And if you look right there at that spinning oval, you see the rate per thousand population is 116.2. For every 1,000 people in our society, 116.2 of them are going to be hospital confined this year. That's 11.62%, which means Sallie can expect to go into the hospital on average about once every 9 years. Well, that's not so bad, except that if you factor in Sallie's entire family, there's a 58.1% that one of the five of them are going into hospital in less than 2 years. Now, what if they're the Brady Bunch? Then the likelihood gets even more. And the first one to be confined is going to run up the exposure. Where's the money going to come from to pay for the deductibles, the co-insurance, and all of the other expenses associated with a hospital confinement, some of which are directly medically related and some aren't, because a dollar is a dollar and spends where you want it to. When you have extra money at the end of a hospital confinement, you probably missed some work. Somebody in your family probably missed some work while taking care of you. There's nothing wrong with having a few extra tax-free dollars, but it's a big problem with not even having enough to pay the bill. Where's the money going to come from? If an agent simply sells an ACA plan to a highly subsidized individual, hey, this is wonderful, you're going to be able to get this for very, very little, haven't I done a fine job for you? The answer is no. Finish the story. Make sure they understand all elements of their program and what their liability is and just how inexpensively you can mitigate it for them. Look at the bridge plan. There's the premium. $10,250 for the bridge plan for every covered family member. First come, first served. Mama could get $10,250. Daddy could get $10,250. Each one of the kids could get $10,250 for that 5-day hospital stay. And you can do it other than November and December. You can do it in months that end in Y. Meet Jack Shortstack. Shorty's your next prospect. Good health, short on stature, short on money. Appreciates a good value, once again, because he has to. He doesn't want to pay any more for anything than he absolutely has to, and it's your job to help him spend his money the smartest way he possibly can. Prospects like Shorty often respond well to products like short-term major medical, and you guys sell a lot of it for a variety of companies, and that's good. Let's look at a couple of them. NatGen. I think they recently had a rate adjustment, so you imagine their rates are probably going to hold for a while. Here they are in South Carolina and Charleston. We use the same Charlotte, North Carolina, and Atlanta, Georgia. We're talking about a $10,000 deductible, 50/50 to $5,000. Now, why did we pick a $10,000 deductible? That is what we call the sweet spot. If you're picking a short-term major medical with the idea that you're going to combine it with a limited benefit plan to mitigate the exposure, you want to get the best benefit to premium ratio, the most bang for your buck. When you get a deductible any higher than that, once you get more exposure, you really don't save much premium. So it's really unnecessary risk. The smart money is right about $10,000 deductible, 50/50. That $10,000, $12,000, $15,000 out of pocket. Now, what does that cost? At age 29, $89.60. Now we're talking numbers that you can live with. At age 48, it's $167.67. And age 63, it's $374. In Charlotte, it's even less, at $320 for that 63-year-old. Atlanta kind of lays an egg, so we'll come back over here. A couple can buy coverage for $165.12, depending upon their age. If they're 48, it's $331. That's still about what an individual is going to be paying for an ACA bronze plan. At age 63, $702. Now, getting a little bit spicy there. But the family coverage, two 29-year-olds and an 8-year-old, $223. At age 48, a couple with an 8-year-old, $390. Guess whose 8-year-old grandson just moved in? I think my roots are showing here on this presentation, but anyway, apologize for that. Two 63-year-olds, 8-year-old, $761.15, $648 in Charlotte. What would it cost to buy a basic plan? We've stepped up a notch, folks. We're now looking at our middle Victory Series plan. Can pay a lot of money, but look, it doesn't cost a lot. This 29-year-old, $90 a month for this much exposure, $110. He's going to pay as much for the additional coverage as he paid for the base plan. Now, wait a minute, that can't make sense until you stop to figure. You add them up, and you get a fraction of what it would cost for a bronze plan. Let's look at IHC, another company you guys represent. little bit lower exposure, but still similar in premium. And the cost for the basic plan is going to be the same. Remember, you can come back to this presentation online anytime you want to look at any of these numbers. And there's a hiccup with IHC. They've refiled their product in South Carolina, so you don't see the figures here at this time. So let's look at that same claim, that same average confinement, 5 days, gallbladder, and see what Shorty could expect to get from his basic plan. Well, we're not getting $50 a day anymore. We're getting $200 for this 5-day stay. There's $1,000. First hospital confinement is $8,000. Surgery is $10,000. Anesthesia $2,000. We're talking $21,000. Now, what was the exposure? The most we looked at in our first examples was $15,000, and that's before any sort of repricing or any other arrangements were made. So Shorty just put $6,000 in his pocket. 11, if you look at the other plan. What's he short? Nothing. Remember, they get Karis 360 with every one of our plans, and some other techniques for reducing the premium even more that we've touched upon and will probably cover again in additional training. So it makes a whole lot of sense if somebody doesn't have an unlimited budget to purchase a short-term major medical with an additional First Choice Victory Series. And remember, not only are they saving money in premium as compared to a bronze plan, but you're talking, for the most part, and in all of the examples we've looked at, first dollar coverage. So not only are you guaranteed of saving the difference in premium amounts every year, whether you have any claims or not. Whether you have any claims or not, you're saving serious money in the difference in the premium. When you have claims, rather than having them cost you, you put money in your pocket. Shorty chose a NatGen plan. $15,000 maximum out of pocket, $10,000 deductible, and 50%. Any charges above $15,000 in network would be covered by the short-term plan. If he had a $300,000 bill, the most he'd have to pay is $15,000. His First Choice basic plan provided $21,000 for that average stay. So what would happen? He would wound up with $6,000 in his pocket, or with IHC plan 11. Now, I'm not saying IHC is better than NatGen. I'm just simply saying that there are a lot of different vegetables in Walter's produce section for a reason. Pick the one that works the best for your client. Now, this premium cost. Let's look at the specifics, because we can talk generalizations all day. Let's look at the facts. If Shorty was 29, the average ACA qualified bronze plan in Georgia, $323 a month. Age 48 would have been $472, and at age 63, $851. North Carolina, age 29. There's the cost of his IHC plan. There's the cost of his basic plan. Short term plus the basic at age 29 is $170. Average bronze would be $352. He's saving $2,177 a year, whether he has any claims or not. That's before he puts the $11,000 in his pocket for an average claim. If Shorty was 48, his combined premium of his short-term major medical and his basic plan would be $278.68. About a half of what a bronze plan would cost. He's saving $2,500 a year, $2,415. That's in a year with no claims. He has the average hospital confinement, puts $11,000 in his pocket at age 63. There's the cost of his short term. There's his basic plan. And yet that's still about a half. And in a good year, with no claims, he has saved almost $5,000, and even more in a year with an average hospital confinement. Stronger than puppy dog breath. He's going to save between $2,000 and $5,000 every year, and more if he actually has claims. Meet Heather Halo. Heather's a sweet thing, and she's a very, very strong supporter of her church, including a Christian sharing ministry program that they endorse. She appreciates her low cost, which is not a premium, it is a share. I have to speak the proper lingo when you're talking about the Christian sharing ministry program. So she has chosen that type of program, and there's 5 of them that were approved by the ACA as appropriate. So she picked one. So let's look at the rates. Her share, she found it attractive and affordable, but there were a couple of drawbacks. First one is good news. $8,000 annual household portion. That would be called a deductible if this was insurance. It's not insurance. There are no guarantees here, which means the family bills go toward $8,000. The bad news is all the bills go toward $8,000. She's not getting any help until she spent $8,000. She's also a little bit concerned that there are no guarantees with the program. If there was something that she could do to guarantee the benefit, she might feel just a little bit more confident in the program. Now let's look at the share, the cost that we looked at earlier in the presentation. What she would have to pay each month, her share for an $8,000 annual household portion, that would be a deductible if it was insurance. Remember, it's not. At age 29, individuals, $134. At age 48, it's $257. Age 63, it's $351. A fraction of what a bronze plan would cost, along lines of what the short-term major medical would cost. The couples, once again, we're just taking 2 of the same. 181 in their 20s. 2 48-year-olds is $388, and then 2 63-year-olds is $550. And then there's your family rates there. With an $8,000 exposure, and none of the guarantees that individuals enjoy when talking about fully insured products. Now, it promises a solid base of protection. Can she afford to have it? She doesn't make a lot of money. That's why she's using this type of program in the first place. Where's she going to get the $8,000 from? You show her the bridge plan. You provide an affordable solution to the dilemma. She's going to be able to get her Christian bill sharing ministry and the bridge plan for less than she could pay for something else. Once again, there's the premiums for the bridge. They now have a level of guaranteed benefits to augment their sharing ministry. And an average confinement with surgery for any member of the family will have a significantly reduced, often completely eliminated exposure. The biggest decision should be, if she understands the situation thoroughly, is to determine whether she wants to buy a basic or a bridge plan. Meet Mike Malady. And if this looks like somebody y'all know with hair, it's not completely coincidental. Mike's a jolly old fella. few pounds short of getting his own zip code. He wouldn't be overweight if he was only 7'7", but he's not. Mike suffers from diabetes, hypertension, high cholesterol, gout, sickle cell anemia, and bunions. He's the ideal candidate for an ACA plan because of the no pre-X, but guess what? He barely makes enough money to pay attention, much less an ACA premium. So that's not an option. And yet, with all of these pre-existing conditions, he doesn't qualify for a short-term plan either. What can he do? Can't buy short-term. Can't buy an ACA plan. And he, let's just say, doesn't fit the mold of the Christian bill sharing ministry, like the one that Heather bought. So what can he do? Does that leave any options? Well, let's look at the deluxe. Now we're putting in the first string. We'll see what would happen with Mike. If he bought a FirstChoice deluxe plan, but he has to be able to get through underwriting. Well, what's underwriting? Mike, do you work an average of 27 hours a week? Yes. Mike gets policy. That is the underwriting. And it's guaranteed renewable, and it's guaranteed issue. And remember, when I say policy, I mean policy. I don't mean a certificate. It's a guaranteed product relationship between the insured and the insurance company with no intermediary group plan that must be kept in place to remain its validity, retain its validity. It's a guaranteed contract. All of those pre-X conditions and others that we talked about would be covered after 12 months. There's only 3 things that Mike could have had that would not be covered after 12 months, that would have a permanent exclusion. And they are, and if you've been through the first 2 trainings, you remember what they are. They are cystic fibrosis, COPD, chronic obstructive lung disorder, and renal failure. There are no inflationary trends built into the program, so the premium does not get higher as Mike gets older, even if Mike started out at 29 or 48 and eventually aged into another bracket, his premium still isn't going to go up. Now, we started out this presentation with a very simple question. Who's a prospect for a Victory Series plan? That seemed to be the question that we were asked most often. I got a question for you guys. Who isn't? We've looked at a significant product. Well, no, Paladin's not. He's over 65. Walter's not. He's dead. But all these other people, ideal candidates for one plan or another with FirstChoice Victory Series. And with that, I thank you. We've gone through technical training. We've gone who do these clothes fit, and I'd like to open it up for questions. Any questions you may have?
That was great. There's a few things that before we start with the questions that I want to go over. CMS recently came out with their open enrollment numbers for this past year. So I want to read those just real quick just to show you why something like this is very important, why people are starting to shop it. Approximately 11.4 million consumers either selected or re-enrolled in the exchange this year. So 11.4 million throughout the country are on the exchange. This is down from last year, which was 11.8 million. So it's not growing, it's getting less, which means people are starting to disenroll or not re-enroll. 24% of that 11.4 million were new. That is also lower from last year, which was 27%. So not only are they not re-enrolling, there's not as many new people jumping on the ship. So among all the consumers in the 39 states, the average premium without a tax credit was $612 a month. That's for the cheapest, that's the average premium without a subsidy. That was actually a decrease from $621. So even though the rates actually did decrease this past year, still people weren't enrolling. And a big play for that is because of the fact that they've eliminated the penalty for having health insurance. But I think the biggest number here that needs to be addressed is 87% of everyone who enrolled on an exchange plan this past year qualified for a subsidy. So what does that tell us, guys? That tells me that people that are relatively healthy, that are not qualifying for subsidies, are shopping around. And even people that have pre-existing conditions are still shopping around. So what Mike Binky has done and what Manhattan Life has done has come out with a guaranteed issue product that can actually end up paying more, if you saw the previous webinars, even more than what a traditional ACA plan, for a fraction of the premiums. Now, is this going to be a product for somebody who's paying a zero premium on a cost-sharing silver plan? It's probably going to be pretty hard to convince them to pay a premium after all, because they'll take a zero premium over pretty much anything. But for those that want good quality health insurance that aren't getting full subsidies, we saw just by these numbers that I read that people are looking to see what else is around. You're going to be very hard pressed to find something that's going to be a better bang for the buck. So I just wanted to point that out there to show you that there absolutely is a need for this product, and that there's going to be huge opportunities for it. So some of the questions were, is this better to be, could this be a standalone plan? And Mike, I think you addressed this, but go ahead and go over that one more time.
Look at Mike Malady there. The guy who had a heart attack, stroke, cancer, diabetes, athlete's foot. He can't qualify for an underwritten plan. He can't afford ACA plan. So sure, that's the best bang for his available bucks. And if he had been in the hospital for 8 days, let's say, suffering from spider bite, which introduced flesh-eating bacteria and cost him a chunk of his foot, he would have left the hospital. His ACA qualified plan would have paid $26,000, and his deluxe plan would have paid $32,000. So not only is it available for any primary insured who's working 27 hours a week, but for anything less than a true catastrophic bill, it could pay as much or more than an ACA plan, often does, and comes with several additional benefits, such as CARES 360, patient advocacy, to help with negotiating bills, to find less expensive treatment beforehand, as well as shaving off some of the cost afterwards. So absolutely.
Another question was, since it's guaranteed issue, why are there so many health questions, and why do they look back 4 to 5 years?
Great question. First of all, the plan has a limitation for pre-existing conditions in the first 12 months. We're going to cover pre-existing conditions after 12 months. Well, how are we going to know what to cover if we don't ask the question? We need to know what the pre-existing conditions are. Secondly, if you're going to stick your neck out further than a giraffe is anatomically capable of, you need to know what you're getting into. If you're going to eat the leaves, you need to know what's in the trees. And we have to constantly pay attention to our demographic, who we are insuring, anticipated claims. We're not rolling the dice on this. These are guaranteed products. We are guaranteeing this money to people. We know what we're getting into, so our clients can be confident in our ability to do what we've done for 17 years, which is keep our rates low and pay our premiums. So to answer your question, we need to know what we're doing. We want to track these conditions, and we have to know on an individual basis which exclusionary endorsements we have to put on the policy. Great question.
The 27-hour rule for the employment to be able to qualify, does that have to be a W-2 job, or can that be something else?
Oh, no, you could be self-employed, but please understand when you're filling out the application, self-employed is not an occupation. Self-employed is a condition. You can be a plumber and work for Spring-A-Leak Plumbing, or you can own the company, in which case you would be self-employed. But you have to put for occupation the duties of employment. There's absolutely nothing wrong with being self-employed. Insurance agents are self-employed, and you can buy this coverage 2 months out of the year. I say 2 months out of the year because anymore you guys don't work 27 hours a week, but in November and December, we all know that. But anyway, sure, self-employed is fine.
So if somebody has a pre-existing condition and they purchase this plan, will it be covered after 12 months?
Unless the pre-existing condition is, number one, cystic fibrosis, number two, end-stage renal, chronic renal, or three, chronic obstructive pulmonary disease, COPD. Unless it's one of those three, yes, it will be covered the same way as if it didn't exist prior, after 12 months.
If the prospect is a diabetic or has high cholesterol, hypertension, does he have to wait 12 months?
Well, that's an interesting question. Let's say your client is hypertensive and he takes medicine for hypertension. Lots of people do. I do. So if I go into the hospital because I've quit taking my hypertension medicine and drank a gallon of salt water, and now my blood pressure is 190 over 110, and I am confined to the hospital for blood pressure, then that would be a pre-ex condition in the first 12 months. But here's the key. About 15 years ago, most states passed laws about language specificity. And what basically happened at that point is you could not blame a myriad of conditions on a pre-existing condition. What companies would have done 30 years ago is if this client had gone into the hospital with a heart attack, they'd have blamed it on hypertension. With a stroke, they'd have blamed it on hypertension. Phlebitis would have been blamed on hypertension. Now you're only going to have the claim denied if the sick code is for hypertension. So there's pre-existing conditions are not big blankets anymore that cover everybody. There is no exclusionary endorsement for the skin and its contents. That's an underwriting joke from 35 years ago, and it's no longer applicable. That's a great question. If your client has hypertension and they go in the hospital because they've had a stroke, it's not going to be excluded.
And you know, Mike, everybody on this webinar today most likely does some work with the ACA and is used to dealing with those that qualify for large subsidies. So they have that option for those that literally cannot afford anything additional premiums. But why this product is so great too is you got to think about the clientele that you're going to be getting by marketing a product like this. You're getting a clientele of those that are relatively healthy. They don't need immediate attention for a pre-existing condition. They have a little bit of money because they can afford at least a little bit of money because they can afford a premium. So the question that you have to ask yourself for those out there that are selling other products other than just health is what can you do with a clientele that is relatively healthy that has a little bit of money? And the answer to that question is anything you want. So yes, we all know how to provide things with zero premiums. I mean, we can all sell zero premiums. That's not a problem at all. And we know the clientele that needs it. But there's a whole nother market out there that's just now becoming a huge opportunity and that we can take full advantage of. So not only are you going to be able to do what's in the best interest of your client and also save them a ton of money and give them a great product that's going to protect them and their families, to appeal to your greed side, you're also going to be getting a great clientele that you can combo sell with anything that you possibly want, and you're getting paid great commissions, because I can attest to that Manhattan Life pays very, very high commissions, and Messer Financial can get you appointed and set up with those high commissions. So from a standpoint from the client and from a standpoint from a agent perspective, it's a win-win no matter how you look at it. So again, and I think Mike did a fantastic job today and in the previous webinars, is showing again why a product like this is so valuable to have in your portfolio. So I don't see any more questions. I will say this, that if you are interested in getting appointed with them, try to start thinking about business that you could submit, because they are a just-in-time carrier. So what that means is they do not finalize your appointment until you submit your first piece of business. And if you submit your appointment request and it's been over 90 days, they will make you resubmit the appointment request. So try to have something in mind that you're going to be writing sometime in the near future before you submit the appointment request. We can get you set up with it. Mike can get you set up with it as well. And I'm sorry, there actually is one more question that just came in, Mike. The brochure states that Teledoc and Caris 360 are not part of the policy, and there's a $5 fee. Is that included in the premium?
It is.
So
the
there you go.
That we looked at, the premiums that are quoted in the brochure, everything we looked at in the presentation already includes that $5.
Awesome. So there you go. You don't even have to worry about trying to upsell anything, because it's already included.
Micah,
it seems like, yeah, go ahead, Mike. I'm sorry.
I wanted to overlay something. I wanted to reinforce something that we've both said. The minute that subsidies enter the equation, premium cost. This is coming from a guy that's been at this for 41 years. Not my first rodeo. The biggest challenge we had for years and years and years, in addition to underwriting, but it was primarily the premium. Where are they going to find the premium? That's immediate. We don't have to worry about claims if we can't afford the premium today. The minute the subsidy entered the equation, I proposed to you that the biggest problem became the high exposure associated with a hospital confinement. And the sad part of that is it could be hidden, because you weren't going to go in the hospital tomorrow. You could kind of put your hands over your eyes like you were 3 years old, the way that protected you from the boogeyman. Well, I'll worry about the deductible and the coinsurance and the out-of-pocket down the road. First, I've got to worry about getting my coverage. Well, eventually that comes home to roost. And one of the biggest problems that we solve is we take the biggest hole in a program, which is the second part of what do I pay to have insurance? What do I pay when I use it? And we turn that second answer more often than not into nothing. The question becomes, how much extra money do I have in my pocket? That's the key to First Choice.
And Mike, that is a great point. You got to think about it. I know every one of you that sell in the marketplace has someone who, is struggling to maybe even pay $50 a month for their health insurance on the ACA. But here's the thing: if they're struggling to pay $50 on the cheapest bronze plan out there, guess what, guys? They still have $7,900 in a maximum out-of-pocket exposure that if something catastrophic that happens to them, they have to cover. So think about that. They can't even, if they're struggling to pay $50. If something catastrophic happens to them, where are they going to come up with $7,900? So again, another reason why just a few bucks more can protect them from ever having to do it. The number one leading cause of people going bankrupt are medical bills. So again, protect your clients, protect yourself, and do what's in their best right. And if it means that we can be compensated for it as well, then even better. So, Mike, it looks like we're out of questions, but if you had something that you wanted to close with, by all means.
I wanted to close with thanking everybody who participated today for taking time out of their schedule to plug in. Let's all learn from each other. Let's do the best job that we can. Remember this. It's I'm not trying to be exceptionally profound, but I believe there's merit to what I'm saying. We all need to remember that while we have dozens, some of us have hundreds of clients, our typical client only deals with a handful of insurance agents in their entire lifetime. There are mulligans in golf. There are no mulligans in insurance. We don't have do-overs. We've got to get it right the first time. You make a mistake with a client, that's why you've got E&O. You'll give better advice the next time. Client makes a mistake, they might be stuck with the catastrophe of that mistake, the financial devastation of that for the rest of their lives. The more you know, the better you can advise, the more likely you're going to help your client avoid that. You have a license. You are a professional. And those of you who take the time out of your schedule to learn what you can, to understand your environment and help your consumers, God bless you. I appreciate you being here. You honor me with your attention. And anytime I can be of service, please let me know.
Very well said, Mike. We appreciate you taking the time to do this for us. Anybody out there that wants to get appointed or has questions or anything, you can contact Messer Financial directly. We can get you appointed. We can get you set up with all the information, applications, rates, whatever you need. We can help you with that. Also, Mike is willing to put himself out there as well to be able to answer your questions. And with that, I'm going to go ahead and close it out. Thank you, everyone, once again for attending. And y'all have a great week, and we'll talk to you soon. Thank you, everyone. Bye-bye.